we're looking at the NASDAQ, 5-day slide. When you look at that, just because of the concentration of tech in the market, does that concern you about the trajectory of the market going forward?
Well, it actually makes me excited. We're finally seeing some signs of the rotation that we've talked about for a very long time, from a concentrated group of global mega caps to some smaller and more value-oriented names where we're seeing some value. And, you know, we think that a soft landing scenario really helps that case.
Where's the rotation take us? We were mentioning this earlier. Energy's the leading sector so far this year. Tech's the laggard. We do have a couple others in correction territory. Where do you see these flows going? Well,
you know, it's always tricky in January where you get bounces based on last year's performance. See some idiosyncrasies in energy. But we see, you know, longer term, a lot of value in smaller companies that are going to be targets of deals, for example, companies that should benefit from their domestic focus and deregulation.
Chris, you're front running this. Your word of the day today is deals. Why is that your word?
Well, there's lots of ways I can mention it. We've had, obviously, a lot of boardrooms across the country dealing with changed landscape post-COVID. One of the ways they can deal with that is getting big or getting out. They've been prevented from doing that by a poor attitude towards M&A in Washington and higher rates. We're seeing some stabilization rates, Fed on hold, and an administration is coming in less than a week, ready to unleash the animal spirits.
All right, so you think animal spirits are getting unleashed, you see less regulation, more deals. That leads us to your pick for today. What is your pick for us today and why?
Well, there's several ways you can play deals. That's buying targets, but also buying companies in the deal business, whether that's banks, we'll hear from later today, or those in the private equity, private credit space. And that's KKR. Was one of the top performers last year. I don't expect a repeat necessarily this year, but we're still, I think, in early innings for the alts market. 17 trillion of assets in that group out of 120 globally. So there's a lot of penetration to be had, is particularly amongst private wealth. That could be helped by some changes in regulation that would allow it to be in 401k plans. And then we get a restart of the whole deal machine. That's IPOs, M&A, recycling capital, and allowing those firms to generate increased fees.
So I just want to be clear. By the way, we're looking at the chart right now. KKR shares up over 70% over the last year, so very strong performance. Do you think KKR is taking private companies? Is that the deals you're talking about, or is there some other kind of deals you're looking at?
No, I mean, obviously, their business, in large part, historically, has been taking companies private or buying private companies and for private investment. Obviously, they're in the private credit business as well, financing deals, but they're a beneficiary of all of that activity.
All right. You know what? This is one thing I want to ask you about. A lot of people talking about alternatives, another big year for private credit, but loan conditions, even though we had a guest saying that he thinks growth is going to be anemic, credit conditions have generally been pretty good. The economy's very good. Why do you think that people are going to go towards private credit, private equity, as opposed to the public markets when they're looking to make a deal?
Well, listen, obviously the banks, structurally, because of a lot of regulation, are moving credit off their books, and you know, there's the private credit providers are there to pick up the slack, essentially. So you know, you're seeing continued growth in that area. Obviously, you have traditional asset managers buying private credit firms as well. So that's going to continue.
All right. Last question. We had a guest on earlier forecasting 3 Fed rate cuts this year. We had some other people saying maybe 2. The forecast, the consensus is just 1. Where do you stand, and how does that impact the market going forward?
Yeah, I think I'm generally in the higher for longer case. Sticky inflation, probably 1 cut along with consensus. I think that's a good situation. We're going to have tension ongoing this year between the deregulation and DOGE and on one side, and tariffs and tax cuts on the other.
One quick question. Expect a inline CPI, hotter or cooler? What are you expecting?
In line is where I would go.